Stop everything you're doing right now. What I'm about to show you isn't just another market analysis or conspiracy theory. This is mathematical proof that we're witnessing the largest financial deception in precious metals history. It's January 20th, 2026, and while everyone's distracted by political theater and stock market headlines, something catastrophic is happening in the silver market that should terrify anyone who understands basic arithmetic. I'm a private metals analyst with 15 years of experience tracking commodity markets. I built this channel because I was tired of waiting for mainstream financial media to report what's happening in real time. They won't tell you this story because it exposes the fraud at the heart of our entire financial system. Here's what I discovered this morning that made me drop everything and record this emergency update. The Perth Mint, Australia's official government mint, is selling 2026 silver coins for $164 per ounce. The COMEX spot price is showing $87.50. That's an 87% premium over paper price. 87%. Think about that for a moment. The government of Australia is telling you that physical silver costs nearly double what the paper market claims it is worth. But it gets worse. I called 5 major bullion dealers this morning. Premiums on standard silver rounds are running $8, $12 over spot when available. American Silver Eagles, when you can find them, are $15, $18 over spot. 2 years ago, those same coins traded at 2 times $3 premiums. The screen shows $87.50, but try to actually buy physical silver at that price. Try to convert your paper positions into metal you can hold. See how fast that liquidity disappears. This isn't market volatility. This is systematic fraud being exposed by mathematics that can't be manipulated. The casino analogy. Let me explain what's happening using an analogy that makes this crystal clear. Imagine a casino in Las Vegas. Not just any casino, the biggest, most prestigious casino in the world. They have a vault in the basement with exactly 1,000 gold chips, real gold chips that cost $1,000 each to manufacture. But here's their business model. They print 100,000 paper IOUs, each promising the holder 1 gold chip from the vault. They sell these IOUs for $1,000 each, making it seem like you're buying the actual gold chip. The IOUs trade freely among customers. People buy and sell them based on their faith that they can redeem them for real gold chips anytime they want. The system works perfectly as long as only 50 or 100 people ever actually try to redeem their IOUs. The casino managers know that 99% of customers just want to trade the paper back and forth, making bets on whether the IOUs will be worth more or less tomorrow. They never actually want the heavy, inconvenient gold chips. But what happens when word gets out that the casino's gold chip manufacturing costs have skyrocketed? What happens when rumors spread that other casinos are running out of gold chips entirely? What happens when foreign governments start sending representatives to redeem thousands of IOUs at once? Suddenly, the casino managers face a nightmare scenario. They have 100,000 IOUs outstanding, but only 1,000 gold chips in the vault. The redemption requests are piling up faster than they can source new chips from manufacturers. The casino has three choices: admit fraud and declare bankruptcy, pay whatever it costs to source chips at $1,850 and lose money on every redemption, or change the rules and declare that they'll settle all IOUs in cash at the old $1,000 price instead of providing actual gold chips. This is exactly what's happening in the silver market right now. The COMEX, the LBMA, and the entire paper silver system are that casino. They've issued far more IOUs than they have silver in their vaults, and redemption requests are accelerating. The mathematics of fraud. Let's run the actual numbers because this is where the fraud becomes undeniable. Current COMEX open interest sits at approximately 180,000 contracts. Each contract represents 5,000 ounces of silver. That's 900 million ounces of paper claims. The registered inventory, that's the silver actually available for delivery, fluctuates around 45-60 million ounces. Let's be generous and say it's 60 million. 900 million ounces of paper claims against 60 million ounces of physical silver. That's a 15-to-1 ratio. 15 IOUs for every gold chip in the vault. Now, here's where it gets interesting. March 2026 is a major delivery month. Historically, 3-7% of contract holders actually demand physical delivery instead of rolling their positions or taking cash settlement. Let's use 5%. 5% of 180,000 contracts equals 9,000 contracts demanding delivery. That's 45 million ounces. If just 5% of paper holders show up for their silver, they'll consume 75% of the entire available inventory. And that assumes nobody else tries to take delivery. That assumes registered inventory doesn't decline between now and March. That assumes the bullion banks don't need any of that silver for their industrial clients or government contracts. 1 delivery month, 5% standing for delivery, 3/4 of available silver gone. The warning signs are everywhere. While paper silver shows 87.50, here's what's happening in the real world. The U.S. Mint suspended sales of silver eagles twice this month, citing supply constraints. Industrial users are reporting 8 to 12-week delays for silver procurement. 3 major refineries have declared force majeure on delivery contracts, claiming unforeseen supply disruptions. But the most telling indicator is what I call the sovereign accumulation pattern. Intelligence sources suggest that China liquidated $420 billion in U.S. treasuries over the last 6 months. If even 2% of that capital flows into physical silver, we're talking about $8.4 billion in buying pressure. At $8,700 per ounce, that's 96 million ounces, more than the entire COMEX registered inventory, from one buyer, from 2% of their treasury liquidation, the liquidity mirage. Here's what makes this situation so dangerous. The paper market appears liquid. You can buy or sell silver futures with the click of a button. Your brokerage account shows instant execution, tight bid-ask spreads, and millions of ounces changing hands daily. But that liquidity is a mirage. It exists only in the digital realm where promises get traded back and forth. The moment you try to convert those promises into actual metal, the liquidity evaporates. I witnessed this firsthand last week. A client attempted to take delivery on 500 contracts, 2.5 million ounces. Standard procedure, all paperwork filed correctly, account fully funded. 3 days later, he received a call from his broker. "We're sorry, but due to operational constraints, we'll need to settle your position in cash at fair market value." Operational constraints. And that's code for, we don't have the silver we promised you. What I'm watching now. There are specific indicators that will tell us when the system breaks completely. First, emergency margin hikes from the CME. When silver breaks above $100, watch for announcements that margin requirements are being raised 50, 100% effective immediately. This forces smaller traders out before the big move happens. Second, technical difficulties with pricing feeds and trading platforms. During the 2022 nickel squeeze, when prices went from $25,000 to $100,000 per ton in hours, multiple data feeds mysteriously went dark. Server issues during the most volatile periods. Third, force majeure declarations from mining companies. Small miners who sold their future production forward at 80-90 will choose to pay contract penalties rather than deliver silver that now costs them 150 pluses to produce. Fourth, the gold to silver ratio collapse. Currently around 53.1, but if silver enters a genuine supply crisis, this ratio will drop toward 41 or even 30.1 as industrial and monetary demand overwhelms paper suppression. My personal strategy. I'm being completely transparent about my positioning. I hold significant physical silver acquired between $16.28 per ounce over the past decade. I'm not selling any of it because this isn't about price, it's about availability. But I'm watching the $85 support level carefully. If we get that dip, I'm deploying 30 to 40% of my remaining cash reserves into physical silver. Not futures, not ETFs, not mining stocks. Actual metal in my possession. I'm avoiding the premium trap on government coins. At current spreads, I'm focusing on private mint rounds and bars from reputable producers. The goal is maximizing ounces per dollar, not paying premiums that may never be recovered. The endgame approaches. The mathematics are becoming impossible to ignore. The gap between paper promises and physical reality is widening daily. Sovereign buyers are accumulating tonnage. Industrial demand continues growing. Supply constraints are tightening globally. Meanwhile, the casino managers, the bullion banks, the COMEX, the entire paper-silver complex, are quietly reducing their exposure. Open interest declining while prices hold steady isn't bearish. It's the smart money exiting before the crowd realizes there aren't enough chips in the vault. We're entering a period where the question isn't, what's silver worth? But rather, can you even get silver at any price? The Perth Mint charging $164, while COMEX shows $87 isn't a pricing error. It's a preview of coming attractions. It's the physical market telling you what silver actually costs, while the paper market maintains its illusion of abundant supply. The system works until it doesn't. Markets remain stable until they're not. And Ponzi schemes function perfectly until the day everyone shows up demanding their chips. The silent exit has begun. The only question is whether you'll be holding real metal when the music stops or clutching paper promises that can't be kept. Something is breaking in the silver market. The mathematics guarantee it. The only variable is timing. Position accordingly.